What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is February 10th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to spend some time to ask a big question. Are we finally at the end of the relief rally? As Bitcoin is down over another 5% as of yesterday, and we've continued to see stagnation and momentum, both in cryptocurrencies as well as equities over this past week. We've got a lot of things to dive into today's video, as well as a very critical chart that I think you guys need to see. So if you enjoy this video, drop a like, consider subscribing. It's one of the best ways you can support the channel. Let's go ahead and kick off the rambling. Okay, let's, as always, start off with Bitcoin here. We've got a lot of things working against the bulls here after a monstrous move of 56.7%, the biggest relief rally or rally from a relative low in this bear market. We have seen stagnation and momentum roughly since back in late January, signs of distribution where institutions are taking advantage of the upward market order flow and buy-side pressure from retail and other speculators and traders in the market. But on top of that as well, we've seen the leading indicator that we utilize for trend reversals flashing that it's likely moving lower here. After a 5% move that we got yesterday. We already started to get some warning signs the other day here, showcasing that the momentum had stalled and a trend reversal is likely in play, but we got a clear, decisive move of 5%, the biggest candle move we've had since back on January 20th. So we're starting to get some direction here. That's clearly showcasing there might be some worrying signs. And it's not just Bitcoin. I'm not just here to bash on crypto, and I'm not even here to say that there's any guarantee that we've got new lows coming, that it's absolute Armageddon just yet, but we are seeing signs that the vast majority of this potential relief rally, I think, has already come into play. That is what I'll say here today. The vast majority of those returns have come in, and I think we're seeing some clear signs that this is not the beginning of another bull market. Now, why am I so confident in this? Because it's not just Bitcoin and it's not just Ethereum. There was obviously some, what many investors are probably seeing as scary news. It might be the initial catalyst for the momentum to the downside, and that is the SEC and other regulatory authorities going after exchanges like Kraken and potentially Coinbase and many other names around offering staking as a service, essentially allowing people to earn yield or additional coins on their ETH or different types of proof-of-stake cryptocurrencies. This is a big value proposition for crypto, that kind of passive yield that people get, even though at the end of the day, if everyone was staking gets the same yield, it doesn't really make much of a difference, but I digress. This is a big feature for a lot of people, and it's a big reason why a lot of people buy names like Ethereum, similar to buying other names in different types of assets that might give you some kind of yield. So this is stepping potentially into securities law questioning from the SEC. And that's scared not just Bitcoin, but Ethereum predominantly, as well as other proof-of-stake cryptocurrencies. But this is just step number one of concern, more within the microsphere of crypto. We got to go even bigger here and start looking at the stock indices and some of our key metrics that signal what the market is taking from the recent FOMC meeting. Now, as you all know, we had a huge gap up here over the period of time from the previous FOMC meeting. From February 1st to the 2nd, S&P 500 rallied from around 4,050 points all the way up to a relative high of right under 4,200 points. So big move up, not to mention, if we take a look at the NASDAQ, we had an even bigger move from 11,500 points all the way up to 12,250. Some monstrous moves in equities, with big names like Meta and Amazon benefiting greatly from cutbacks and layoffs on their cost structure, and starting to see higher elevated prices with double-digit moves over a period of 1 to 2 days. But even though the market at that time was supposedly so convinced that the Fed was bluffing, that the Fed's not going to tighten. Please, we're going back to the good times. This is, I know we've called it for 14 times, folks, but this is going to be the time where we start to see the Fed come stepping back in. They're going to start providing the easy money again. Well, even I think the retail crowd, the broader traders that have been trying to buy every single dip along the way, who have been trying to fight the Fed along this journey of tightening inflation, even they are starting to call. Even they are starting to realize that the game is likely over. that the relief rally, which was short-lived, is likely coming to an end here. I'm not saying it's absolutely over just a second. Could charter up a little bit more for the next couple days. Who knows? But the big thing here is this. The relief rally has already made some monstrous moves. Even taking the existing rally we've had so far, this is a 20% relief rally. It's in line with previous ones. And this has taken us back to where we were back in August and September. And during that period of time, the Fed has continued to raise interest rates, and it has not stopped raising that target rate. As Jerome Powell said, we've got a good ways to go here. And even from this, even though we might get a move higher here, we might come up towards 12,500 points, we might get that continuation. Is it really worth chasing the trade? I gotta tell you guys, taking a look at how Bitcoin is reacting, the risk on asset above any of these indices, seeing how stock indices themselves are fading, closing the gap down, and have not been making new highs over the past week or so. Hey, these are the things that should be flashing confidence when everyone is downing. And we're not seeing confidence coming out of that FOMC meeting on a net basis. Now, crypto is one thing, equities are another. But if we take a look at the broader charts, things start to get even more concerning. And it starts bringing us back into the picture, the decade-long picture of where we're really at right now, that no one on YouTube, the vast majority of content creators won't focus on because they're not macro traders at heart. And on top of that, many people started investing over the last decade where times were good. Probably the best they've been in a long period of history, in decades probably since the dot-com bubble, in a period where more retail traders have had access to financial assets than any time in history through different means and ways. Now, the big thing I want to focus here on is the VIX, the US 2-year yield, and the dollar index. All of them spiking up, really, since February 2nd. And we had a deviation, a temporary deviation, right into the pocket. Look at that. Each and every time for the past 5 years, actually more than 5 years, since back in December of 2017, this has been your point to start going short equities, to start betting on increases in volatility. And just like that, we went from around 17.25 here on the index up towards 20, almost nearly 21 points on the VIX. And as you likely all know, the VIX goes up, equities likely go down. It is usually that there's an inverse correlation between volatility and price action, meaning that when volatility and uncertainty in the options market is spiking up, that is when we have our cue for equities to start moving lower. On top of that, the US 2-year yield not letting up. We talked about this back earlier this week. We are at the highest point for the US 2-year Treasury yield since back in November. And the question is whether or not it will fade like it did in November 28th of 2022 or January 2nd of 2023. Either way, this is a big sign of confidence. All those losses that we saw since back in October, when the market started to price in a lower Fed funds rate, started to believe that the Fed may be able to approach the soft landing and start flattening out its rate increases. Well, don't be so surprised if Jerome Powell just keeps raising by 25 basis points and takes it even further. Because the US 2-year Treasury yield is showcasing that. One big thing to understand that's a very important dynamic is that I know a lot of people will say, oh, the bond market will predict what the Fed does. And while that's true, the bond market does try to predict what the Fed is going to do, and it is much more accurate at doing so than, say, what equity markets are doing. The reason why the bond market is intrinsically much more valuable is because not only it's managed by a much larger and respected pool of investors who know how to trade within bond markets, and also are much more defensive and protective investors who focus on the fundamentals. But putting aside all of that, the biggest reason is because if the Fed is going to raise interest rates, the bond yields will adjust. They will follow the Fed, right? So that's why they have to really listen between the lines and actually think about, hey, is the Fed serious here? They're really going to be raising interest rates, because if they do, if that Fed funds rate goes up, that's the same reason why the 2-year yield and other Treasury yields skyrocket during the same window of time. You can overlay the chart here. We could put the federal funds rate. I'll show you guys just here on the chart. We can go ahead and put the federal funds rate. And just like that, when you put it on the same panel here, we could see during this period of time that there was a direct increase here between these. And the treasury yields even lead the market a little bit. You start to price in that the Fed is about to make this move. So again, really valuable stuff. If you can learn to lean into this and see how the bond markets give you those signs, it could have helped you to start taking positions off the table in November during that period of time, even before the Fed started to raise interest rates. The bond market knew that the Fed needed to contract monetary policy. Simple details like this that bore 98% of investors are what are going to make you the top 2% of investors out there in the market. By simply following these things, you can start to think ahead of the curve. We need to think a month, 3 months out, because if we can start to predict these moves, we're going to be making the serious swing trade opportunities. We're going to be making some good returns, shorting to the downside, buying oversold dips, and generally waiting in cash to go long term when we get that real capitulation event. And I got to tell you guys, I don't think we've seen this yet. I know a lot of people are convinced, oh, there's soft landing, we're going to be able to make it through. I got to tell you guys, I think that people who think that we've got another thing coming here. This is a long-term reversal, right? If I can pull it up here, maybe on the 2-year yield, go ahead and turn off the logarithmic chart. I really want to emphasize that this is not like 2003 or here in 2018. There's a reason we've blown past the previous high, because now we have gone on a potential decade-long journey or multi-year process where the Fed is not on a longer-term downtrend of lowering interest rates like it's been doing since the 1980s after we had our last peak of inflation. It is on the other curve. It is on the initial stages of an uptrend. And if the Fed does not get ahead of inflation here in the short term, it's going to have to do so in the long term, and it's going to have to do a lot more. I got to tell you guys, when we've got the federal funds rate going at the pace it's at, the one thing that people are not thinking about is the balance sheet. And we've talked about this time and time again. This has got a long way to go. So we're not going to be having the Fed printing money. They can't do that. It's going to ease financial conditions. They really can't just sit on the sidelines and not reduce their balance sheet. So they're actually reducing liquidity. They're doing quantitative tightening and removing supply of capital in the economy. How is that going to inflate asset prices? How are assets that only survived and actually were able to come into existence when the federal funds rate was 0 to 1%, how are they going to survive in an environment where federal funds rate is 5%? What if it goes to 6 or 7%? All right? What if we get a secondary wave or spike in inflation, just like we did back in the 70s when the Fed started to ease up too much early on and didn't get ahead of inflation? I think the market is starting to realize, and this is the good piece of news, is that the Federal Reserve made it very clear this past week, at the beginning of February, that it is going to, again, continue to increase interest rates. This gave us some renewed confidence in the 2-year yield as well as the dollar index. But while this is all fine and dandy, whether or not we've got a perspective that the Fed is going to ease, whether you think it's going to tighten, this is the big chart I want you guys to keep in mind here. And it's not something that you need to do anything like start like right now, right? I don't want to be all doom and gloom here. I don't want you guys to be overly emotional in trading and stuff. I know you guys are very sensible. If you're here right now, if you've made it this far in the video, you guys are in the top crowd of traders and investors who are just trying to understand what's the general outlook. And that's all I'm here to do, because this chart will give you the answer you're looking for. As you all have maybe heard me talk about before on the channel, I bring this up probably once a month. This is the US 10-year yield spread between the US 2-year yield spread. Now, you've probably heard about yield curve inversion. And this is essentially when the shorter term bonds are starting to pay just as much, if not more, than the long-term bonds. Okay? Now, again, without going too much into detail here, essentially speaking, when we see a decline in this spread, right, when we start getting into negative territory, right, which actually starts roughly about this range here. So if you look back in 88 or 89, if you look back at 2000, look around 2007, do any of these years ring a bell? 2007, 2008, 2000, the late 80s? Those are the last 3 significant bear market territories for equities. Now, I'm not saying that the yield curve is absolutely perfect, but damn, it is one of the best indicators over the last century of future recessions. I know a lot of people think that, look at the labor market right now. It's red hot. We're doing great. We're going to survive this. It's all going to be good. This soft landing. It's transitory yet again. I'm not here to laugh about a recession. I'm laughing at the fact that we are ignoring the fundamentals of economics. We're ignoring and thinking that, the Fed can start using new measures for inflation. We can start doing this and that. He's going to go back to printing again. And we're ignoring the fact that the yield curve inversion is probably the biggest it has been in over 50 to 60 years. Maybe throughout its entire history. We just don't have the data to work with here. And we think that there's going to be a soft landing. The US 2-year yield is coming up, and I think we're pretty much on pace over the next 3 months to potentially see the US 2-year yield paying an entire percentage more than the 10-year yield. What does that tell you about the future outlook of the economy? It tells you that the markets think the Fed is going to hike big time and that we are going into some really messy stuff. This is going to be a difficult time for the economy, and anyone who's still thinking like investors of the last decade, all I would say is that when you see a good quarterly flip here, a good green candle, and the US 10-year to 2-year yield, when that inversion starts to revert, that's your sign to run for the hills. That if you have not built some cash positions, taken some profits off the table, you don't have to do it this minute, but I would say that that's usually the optimal time to do so, at least according to history. And I'm not here to give you guys direct financial advice. You got to take what I say and what others say and use it for your own investing journey. It's not about getting everything right. It's about trying to find the most sensible people who are giving you the best quality information and you going out there and doing the best with it possible. Because while we may not be ready to flash crash tomorrow, there will eventually likely be a correction point here, at least according to the 10-year, 2-year spread. This has been one of the most consistent recessionary predictors in history. And recessionary bear markets usually correct anywhere from 40 to 60%, historically speaking. To ignore that fact and think that this time it's different because of AI, because of meme stocks, because the Fed's just going to think inflation is transitory or whatever narrative gets shared out there. All the talking heads who benefit, by the way, from you using their referral links, from you investing in a mutual fund or some type of investment vehicle where they get commission. All those talking heads have probably preached to you. They don't care if you lose your socks because at the end of the day, they want you to get in the door and buy investments. Me, on the other hand, I just want to be as honest with you guys as possible. It's what makes me motivated, gets me excited to wake up in the morning, and there's tons of exciting macroeconomic data to dive into. I want to be right in the end. I think as any investor, any good investor wants to do at the end of the day. And that takes a lot of patience, takes a lot of consistency and focusing on the data points that matter, and being disciplined to strike when the signs of a trend reversal are at play. Now, one thing I wanted to share real quick for those of you who are interested in long-term investments in the space. If you guys already like this video, consider dropping a like. If you haven't already, it definitely helps out the channel big time. But if you guys are interested in finding more quality investments, and I know earlier we were talking about some of the structural changes happening in the crypto space, I thought this would be a good time to talk about one of our partners here on the channel, AngelBlock. Now, if you guys haven't heard about AngelBlock, AngelBlock is aiming to not just build another launch pad or fundraising service. They're aiming to build something much bigger. They're aiming to build a platform that is setting new weights and standards for any projects or protocols looking to fundraise in the crypto space, whether they be projects in the crypto space or companies and other different industries. Essentially speaking, it is allowing not only a broader retail crowd to be able to participate in the early stage rounds that used to be exclusive to inside large-scale accredited investors, but on top of that, it's going to be offering some really exciting deal flow and checks and balances that make sure that the projects themselves deliver before they're able to walk away with a large sum of money that investors give to the project. This is mainly done through AngelBlock's focus on tranches. And this is a big dynamic that has been something I've been wanting to see in the crypto space for a long period of time, that basically, if implemented, could prevent the vast majority of rug pulls, the vast majority of scam projects, and VC projects that raise too much and deliver too little. This is a big problem in the crypto space, and it's why the vast majority of altcoins, yet again, are going to fail like they have in each and every bull market, because the same unfortunate incentives still remain. AngelBlock is here to fix that though, and there's some big developments that you guys need to be made aware of. If you haven't heard already, the Thol token, which is the native utility and governance token for the AngelBlock protocol, is going to be having its TGE on February 15th, and shortly after, it's going to be having the IDO. So if you guys are interested, it's going to be launching on Uniswap starting at 10 cents. If you guys want to check it out, I highly recommend you do. I'm not here to say you should buy it or anything. I'm just recommending that you guys look into AngelBlock, understand the utilities of the token, and ideally, if the platform itself grows in adoption, if there's exciting deal flow, people investing and participating in the ecosystem, then there you should see some really exciting benefits coming towards the overall token itself. So keep an eye on the Thol token and the launch that's going to be coming up on the 16th. And if you guys haven't already, definitely consider following AngelBlock on Twitter. I highly recommend it. It's definitely one of the few projects that I'm excited about. As I've mentioned before in a previous review we did, I'm an ambassador to the project. I've known Alex, the founder, for a long period of time, as well as Kate and the team. They're really wonderful people, and they're aiming to fix a critical issue. I have to say, if this isn't resolved in the crypto space by someone like AngelBlock, unfortunately, crypto will never recover, because the fundraising process and the projects that receive capital should be quality projects. And that's been a huge problem over the last decade. If you really think about the vast majority of crypto projects, many of them have not been able to deliver anything material outside of some names like Uniswap or other layer 1 protocols or layer 2 ecosystems that have served some kind of value in the space. So AngelBlock can help us with this. So check out the links down below in the description if you guys are interested. But I wanted to go off and close on a really interesting note. Mohamed El-Erian, which is one of the major economists, thankfully that CNBC and some of the other major kind of news outlets actually give some space towards, Bloomberg, you name it. They've actually given some space to someone who I think is deserving of it. And the Financial Times allowed for a really interesting op-ed opinion from Mohamed El-Erian, where he talked about the paradox of financial conditions. And he basically, at the end of the day, and I'll go ahead and just kind of bring up this highlighted portion that he focused on. He talked a little bit about the disparity between the United States Central Bank and other central banks. But what he really talked about that hit home for me is financial conditions, easing financial conditions. One of the big problems that we talked about in this month's previous newsletter, if you guys want to check it out, there's a link down below in the description. But we talked about this concept of easing financial conditions and how easing financial conditions are utilized as this trap for the Federal Reserve in order to absorb excess liquidity. Right now, the fact that the markets popped up as much as they did over the past week or so following the FOMC meeting, or prior to that, over the past month or so, is a clear sign that there is still too much excess money in the system. We still have double the monetary supply we had before. And he hits on a very good point here, which is that there is a disparity between what the Fed is saying and how the markets are reading it, which is something that cannot be ignored. It plays exactly into what we're talking about, which is that financial markets are living in one world and the Fed is living in another. And eventually, as we know throughout history, the Fed puts down the hammer and those financial conditions go right back down. The only question you have to ask yourselves is, do you want to risk being a part of that? Or do you feel like it's best to not risk potentially missing out on some kind of rally like that? The biggest mistake people make is, at the end of the day, the biggest mistake they make is chasing what they could make and not asking the question, what could I lose? There's plenty of ways to lose money. There's only a few ways to really make money in the long term. That's it for today's video, guys. Thank you so much for listening in. As always, if you could drop a like, and I'll see you guys in the next video. Take care, everyone.